I thought that my private lenders paid a higher interest rate. And I thought that if I paid a higher interest rate, that would incentivize them to lend me more money, right? Which makes sense. But what I found was that for people who invest in stocks, once that interest rate gets high or the return promised gets high, that looks risky to them. And so I remember I was meeting with a potential lender. I was offering him one loan at 10% and another loan at 8%. And I was trying to incentivize the 8. And I'll never forget, he heard both of them. And then he said, 10% sounds risky. Let's go with 8. And I thought, okay, so they equate a higher rate of return with higher risk, which in essence it is, because if I borrow the money, my payment's going to be higher, my cash flow will be smaller. And so I lowered it to 8%, and then I lowered it to 7 and raised more money, and lowered it to 6 and raised more money, because the lower the interest rate we're willing to pay, the lower the risk of that investment.
Welcome back to the Profit First REI podcast. It's David Richter. I have Chad Harris today. I have gotten to know Chad here recently, and I love what he's doing in the real estate investing community. Honestly, I love this topic. We don't talk about it enough because this is the Profit First REI podcast, and I want to make sure you have cash and cash flow and that you're not always having to use your own cash. And Chad is an expert at raising money from private lenders. So we're going to focus on that a lot today. So Chad, thank you for being on today, and I'm super excited about learning about this with you.
Hey, glad to be here, David. Appreciate the invite.
Yeah, well, I want to dive into this. And first, before you tell me your whole story about how you got into real estate and all that, because everyone's got a story, right? Why did you go down the road of private lenders versus either using your own money or, I don't know, bank financing or anything like that? What drove you down the private lender path?
Yeah, sure. So I got into real estate. I didn't plan to. My background was I was a high school English teacher, and then I was a missionary overseas in ministry. And so I lived in rural Kenya, very remote setting. And for that work, I had to raise a lot of money. So I got used to having those conversations about money and just how that conversation works, and got very good at it out of necessity for ministry, and never had any plans to get into real estate. But then in 2013, my youngest son was born and had health issues, and we couldn't return overseas. And I realized that not only did I need a way to pay my bills, but I really just felt that I wasn't providing enough for my family. I felt like they deserved more than I was providing financially. And so decided to go into real estate. I've been listening to podcasts and reading some books. And I just went out there and started telling people, hey, I'm buying properties. I'm buying rentals. At the time, my income from the job was $2,000 a month. I had no savings. My job was ending because we couldn't return to Kenya. And I looked terrible to a bank, right? There was no way I could go into a bank and borrow money, but I was just committed to figuring it out. One way or another, I was going to figure out how to buy rental properties. And I kept finding over and over people, and I would be telling them I was buying rentals, which I think in reality, a lot of it was I was just casting a vision for myself, right? Trying to convince myself I was going to be able to do this. But over and over, people would say, oh, that's amazing. I wish I could do that. I always wanted to do that. I looked at buying a rental and then got nervous and just never did it. And I realized there was an opportunity where I could help them, right? All these people I was running into wanted to get into real estate and wanted to get involved in rentals, but for one reason or another didn't. And I could help them by helping them get into rentals, but as a lender. And they could be just like the bank and get all the returns like a bank and the security that a bank gets. And at the same time, I could have access to that money and buy the rentals that I wanted. And so I really leveraged the skills I learned in ministry and fell into the private money concept. But that's how I bought my first 25 doors. And then I started to figure out some seller financing ideas. And still at 80 doors now, we never used a bank for the purchase of a property. So, which is nice. That's a good deal.
Yeah. Yeah, it is. That's awesome. I love that you've used private money, seller financing, and like not having to use a bank. It seems like at the beginning out of necessity. Now it's more like, okay, this is just part of your system and part of what you do, to the acquire the doors and get in there. So that's a very interesting story too, that ministry prepared you to raise the private money, because it is, right? Because when you're in the ministry, you're raising the funds to be able to be there on the field or to be able to go. And that is like, it's funny how it's a little boot camp almost for real
Yeah.
estate
Yeah.
investing, because of that. So that is so interesting, and I love that story. So then, talk about, since that's where you dove into, and now you've got the doors and you're teaching other people, what are some of the best places to find the private lenders?
Yeah, so there are private lenders all over the place, and that's probably one of the biggest misunderstandings about private money with people that I talk to. They think like, okay, what's this one location, or how do I find these elusive? And they act like it's kind of this elusive animal out in the woods, and how are we ever going to find it, like a Sasquatch or something? And reality is that there are potential private lenders everywhere, no matter what circle you are in, right? So if we look at what we offer our lenders, we're giving them a fixed rate of return, and our lenders, just for clarity, so everybody understands what we're talking about, our lenders are going to loan the money for the purchase and rehab, and they're going to have a first mortgage just like the bank. So they're going to get their monthly payments just like the bank, and all the security that a bank gets, right? It's recorded with the county. And so we're giving them a fixed rate of return. That investment is secured by real property, and it doesn't matter what happens to the stock market, their investment stays the same, right? And those benefits perfectly fit what a whole bunch of people out there have been told to look for by their financial planner. The financial planner tells them they should diversify their investments, they should have some money in the stock market, and the money that's not in the stock market, they should have in something that gives a consistent return, but they should only expect 3 to 4%, right? And we're offering a consistent return, not risking the principal in the stock market at a higher interest rate. So we offer 6 to 8%. And for a lot of people, that's an amazing return. As a real estate investor, we feel like that's kind of low. And why would somebody want to lend money at 6%? But for somebody whose financial planner has been telling them for 30 years that in retirement they should expect 4%, if we pay them 6% or 8%, we're actually drastically increasing their lifestyle, right? We are drastically increasing the vacations they can provide in retirement, what they can provide for their grandkids, the experiences they can have. We're giving them a 50% to a 100% increased return on really how they live in retirement. So there are potential lenders all over the place. And there's a real simple process for just initiating that conversation, right? I like a 3-part introduction where you just tell people what you do in a very specific way. So you want 3 parts. You want your why you do what you do, what exactly you do, and then how others can be involved. So for me, it is, um, I love improving neighborhoods. I buy beat up properties, fix them up, rent them to great families, and I share the profits with friends, family, and people I know. And I include that introduction all the time, every time, wherever I meet anybody new. And over time, you just have all these conversations where people say, wow, I never knew that. I didn't know. How is it? How does that work? How can I profit in the deal, or how can I share in the profits, right? Who doesn't want to share in the profits of a real estate deal? That's an exciting opportunity. And so there are places where you can be in circles where there are more potential private lenders, but the general answer is there are lenders all over the place. They just don't know they can be a lender in our business until we educate them on that.
Okay. So that makes sense. So you're looking at when you go there and you go and just out into the world of like, okay, if there's someone that I meet, there's this set of questions that I have, or like what I have to offer and how I can present it to them. And I like your little framework of the why, what, and how, and like what you're doing and why you're doing it, and then how they can get involved. I like it keeping it very simple. But then as well, too, it's like you said, there's other places where more might congregate. And before we were on, I usually do this at the end, but this might be a good place just to drop this link. Tell the link that you have to find lenders if people are like, hey, I want to go deeper into that. I want to know more. Like, how can they find that thing that you put together?
Yeah, definitely. So I compiled a list of circles, basically groups to get into and places to go where you're just naturally hanging around people who are potential lenders. And it's 37 plus places to find potential lenders or find private lenders. You can get that list. Go to truewealthinvestors.com/find lenders. Happy to share that with you. A great resource, especially to get started. You know, that first, when you're first sharing your story and looking for that private lender, it feels really elusive. And once you get the list and you try out a couple spots and start having those conversations, you can gain confidence and then really find you have access to money all over the place. You just didn't realize it. So yeah, definitely check that out. truewealthinvestors.com/find lenders.
Awesome. So that's that website, truewealthinvestors.com/find lenders. So if you're like, okay, I love this. I don't want to be using my own money. I need some help and support. That's where you can go and get the 37. I love that it's that number. It's like just 37 places you could go and find private lenders out there in the marketplace. And so that's that link, truewealthinvestors.com/find lenders. Now, Chad, I also wanted to ask, why did you choose the rental path versus other paths in the real estate world, like flipping, wholesale, commercial? I don't know, like all the different things out there.
Yeah, completely. And it's interesting because really it would have, from the outside, it would have made more sense to flip or wholesale or do things that gave me quick, piles of cash, essentially. Um, I was familiar with rentals because my parents had rentals, and I saw in their life that over time those rentals had provided good things for them. And when I got started, um, it was what, 2013. It was still the recession. There was still, at least in our market in Dayton, Ohio, there's a ton of inventory, and it was hard to sell. There wasn't much financing. So for me, having access to private money, all cash, I could buy all kinds of deals, right? And so I saw that if I bought a rental, even though money would be tight, if I held on to it over time, things would just all work in my favor. And as long as I could feed my family and pay for a roof over their head, I was more committed to that long-term wealth and long-term impact. And so I did have some creative strategies to help pay for, my kids, they have this tendency, they want to eat on a regular basis. I don't know if all kids are that way. Yeah.
Yes, yes, they are.
Yeah, they are. So, I ended up structuring my deals because if you're making, let's say, $200 a month, 250 a month from a rental, you have to, you have to start to own a few rentals to be able to support yourself. And I wanted to be able to support myself day one without any rentals or just buying my first rental. And so the way I did that was, I was doing essentially the Burr strategy, but it was before everything had an acronym and, before that there was a book. But I was buying the properties all cash, and I was raising more money than I needed for the purchase and the rehab. So let's just say, for ballpark numbers, this house, the ARV is going to be 100,000. I'm buying it for 50,000, putting 10,000 into it. So I'm raising 65,000 and keeping 5,000 for myself when I purchase it. then fix it up, rent it, and then refinance it and pull out 75,000 and then keeping money from the refinance. And so I made a little bit each month off the rent, but I made money every time I bought a house and I made money every time I refinanced a house. I was buying with private money and then refinancing with private money, just short term private money and then long term private money. And so
Yeah.
to support my family, I just knew I had to do more deals, right? As long as I was buying properties and refinancing properties, everything was good. But if I stopped, suddenly I'd be short cash. So that totally incentivized me to build a portfolio of rentals and buy as many as I could. And for me, I was right. It was lean in those early years, but man, it sure works out well in the long run. As property values rise, rents rise, you start to pay down the debt. I've just found that with rentals, everything works in your favor over time, right? And so, as
Yeah.
long as I can accept the lean days on the front end, the back end really works well.
That makes sense. So you found that rentals, especially with the Burr model, you were able to generate cash when you bought, which is very cool, but then also when you refinance, but then you also were building slowly over time the passive side, the cash flow from the rentals as
Right.
well. So then you had monthly income coming in, which was very useful. And then you, like you said, the long game turned out to be worth it. So maybe you were a little bootstrapped at the beginning and like, okay, we got to get through this period. But I do wonder because you said you bought your first 25 houses. Like, how long did it get you to where you didn't feel like the pressure every month? Was it 25 deals for you? Was it 50 or 80 doors? Or like, where did you finally feel like, okay, it's not, oh my gosh, I'm just panicking every single month at this point?
Yeah, that's a good question. I'm not sure what that exact point was. It was probably around 30 doors if I had to go back and look at it. Um, and the reason for that in reality is that I didn't have somebody to kind of explain to me how to structure the deals and how to set everything up correctly. I was trying to survive, right? And trying to survive, you don't make the best decisions and you're kind of learning as you go. And I structured a lot of deals early on where I had really high monthly payments to my lenders, thinking that they wanted their money paid back. And that was my preconceived notion, is that my lenders wanted paid back. And that gave me really low cash flow in the early years. So it took me about 30. Later, I discovered that lenders don't want paid back. They just want a return on their money and they want their money kept
Mm,
invested. And that drastically changed everything, right? That was one of those things. I really wish I had somebody to tell me that up front, because that would have saved me so much time and energy and cash flow in the early years. And so if I were to
makes a lot
start
of
over
sense.
again, it'd be much less doors. Yeah. Yeah,
Yeah.
because most stock
Yeah. No, I
investors,
like
they want to put their money into an investment and leave it and just get a good return. And so the payment, typically a private lender doesn't want an amortized payment. They just want an interest only payment so that it looks more like a dividend, right? Which is what they expect to get off of their investment.
it. I really like that because you're meeting the lender where they are and you're really understanding what they want and being able to ask that question, and eventually figuring that out. But that's where if someone doesn't have maybe a parent who is in rentals or someone that's never been in the real estate world, that's where you would come into play to be able to say, here's what not to do, here's what to do. Like this is where to be able to get that help as well too on down the road. I did want to ask before like how people connect with you besides obviously the one where they can do the finding the lenders. I did want to ask before that was how did you know that in this space, like with the rentals and everything that you were acquiring and over the time, I want to know too, man, I lost the question. I was leading myself and then I completely lost it. I think this is the first time on the podcast that I've done that where I had the question and it is completely out of my brain, and now I'm completely stalling on the podcast while I'm doing this. So I'm either going to edit this out, or this will
Nice,
be a very
nice.
funny little segment here. And yeah, I'm sorry, Chad. That I completely apologize for this, but I
Well,
know that
I can
obviously
share a
I will.
quick tip. While you're thinking of the question, another really quick tip is another thing that I really messed up from day one was I thought that my private lenders wanted paid a higher interest rate. And I thought that if I paid a higher interest rate, that would incentivize them to lend me more money, right? Which makes sense. But what I found was that for people who invest in stocks, once that interest rate gets high or the return promised gets high, that looks risky to them. And so I remember I was meeting with a potential lender. I was offering him one loan at 10% and another loan at 8%. And I was trying to incentivize the 8. And I'll never forget, he heard both of them. And then he said, 10% sounds risky. Let's go with 8. And I thought, okay, so they equate a higher rate of return with higher risk, which in essence it is, because if I borrow the money, my payment's going to be higher, my cash flow will be smaller. And so I lowered it to 8%, and then I lowered it to 7 and raised more money, and lowered it to 6 and raised more money, because the lower the interest rate we're willing to pay, the lower the risk of that investment. So that's a good tip for everybody. Don't think you have to pay
That is a really good
12%
tip.
or 10%. So
Yeah, no, I like that a lot, and that's where, honestly, you kinda answered the question that I had because I thought of it. It was like, what else would you do different at the beginning? And it sounds like you would not offer as high of a rate of return to people, or an interest rate, because of the perceived risk at the higher levels, and the actual risk, obviously, to you as well too. But is there, I guess that's it. Is there anything else besides those 2 things? Because those are 2 pretty big things. Obviously, like, knowing if the lender wants to get paid and the higher rate of return. Is there anything else that you would have done differently at the beginning?
yeah, I'd say the only other major thing was in the beginning, I structured, even if it was interest only, I structured it as 4-year loans. And I thought they want some form of liquidity, and we'll review it every 4 years and they can extend it, which seemed great, right? And they were happy with it. The problem is once you have quite a few of those and they're all randomly, coming to a balloon at different times, it gets a lot to manage. So now we do 10-year loans, interest only, fixed interest rate, and the lenders still love it because they want to invest long term. There's no penalty if they want the money back early, but we know that we're in it for 10 years together and we can extend it from there. So that's what we do now. 6% interest only, 10-year loans that can be extended. And for anybody just starting, that's what I would recommend, because it's going to fit. It's not going to look like a traditional real estate loan, but it's going to fit what your private lender is looking for. Just a fixed rate of return where they can invest their money and leave it, and it continues, and they're not getting principal back, just interest. So.
Awesome. No, yeah, that's really good advice, because a lot of people out there, they go into it and they don't have any idea what to do. And where it's like, you have this proven process, you've cut your teeth on lots of deals and what to do, what not to do. So I like how y'all wrapped it. That it was very cohesive with, number one, make sure you're paying them as they want to be paid. And usually that's more in your, like, you can push the system to what is more favorable towards you, because then that's less risk to them if it is less risk for you, which also includes the interest payments, and the interest rate, and also the term of the loan too. And that also helps your internal systems have a little bit more time to be able to say, okay, I need to set a 10-year reminder versus 4 years, and all these are just popping off every 4 years without, like, oh shoot, I've got a lot of things coming to a head at this time. That way, that gives you the time to build out those processes, to know what's coming up, and then to be able to extend at that time. Or, 10 years is a long time. So being able to say, hey, did I keep this for 10 years? Did I pay them out within those 10 years? And, it's just so many different things that can happen in real estate. So you're giving yourself more time and more buffer, it sounds like, as well, too. And you learned this from the
Right.
School of Hard Knocks. So I wanted to ask, for people's sake, obviously you have truewealthinvestors.com/find lenders. But if they want to find you or like what you're teaching or being able to follow you, do you have like if they just went to truewealthinvestors.com, would that send them on the path to like potentially working with you or your content, all that out there?
Yeah, truewealthinvestors.com, perfect place for them to find more about me and what content I have there. A lot of free training and all kinds of information on what I do and how I structure the business and how I help other investors build their businesses. Definitely.
Awesome. Well, from this conversation, I will say one of the things I'm picking up is that you're very calm and that you're very like even tempered. And this space can be full of people that are not. So it's like this is very refreshing to me as well too to have this conversation where if you're out there in the marketplace and you see all these people posting crazy things, honestly, I can get very like, oh, just hyped up as well too on some of these videos and whatnot. And it's like, if you need someone in your life like Chad, who's been there, who's going to keep an even head, who's going to keep that even keel, and who's going to help you build a good rental portfolio, be able to find the private lenders, and be able to also different exit strategies, but also internally acquiring strategies too of like, hey, you could go seller finance and the rent and like what he was doing even at the beginning and the Burr model. So he's got the different expertise there. Go to truewealthinvestors.com. That's where you can find him and the information. And if you're out there saying, you know what, I'm already in this space, I went down this road, but I need help with my cash and the cash flow. Maybe you are using all your money and you need some of the private money, or you need to know where the money's coming from. We can help you on the financial side with Simple CFO and with making sure you have your numbers in order so you can run your business like a business owner. So if you could go to simplecfo.com to book a call there with our team, we'd love to see if we could help you on that side, take that headache off your plate. But this is where, Chad, this has been awesome. Thank you so much for sharing the ups and downs that you've been through in real estate and being real, and then those really good tips of what a lender really wants and how to mitigate that risk for yourself. So thank you so much for sharing that today.
Hey, glad to, David. Always enjoy the conversation. Thanks for having me on.
This episode of the Profit First for REI podcast is over, but there are plenty more where that came from. Are you ready to learn how David and his team can help implement the Profit First system in your business? Schedule a discovery call at simplecfo.com right now. We'll see you next time on the Profit First for REI podcast with David Richter.